Rentvesting is a strategy that's becoming really popular. And if you actually look at the richest people, they're all doing the same thing. Yet you've been told a lie that if you rent, you're poor. I'm gonna break this down with an actual example using an Excel sheet so you can follow along, and you're gonna realize if you remove your emotions and purely looked at the data, why one makes more sense than the other. Now be sure to stay till then because I do share something that most people aren't considering, and especially when it comes to wealth building, they aren't thinking about. So if you're interested in what my thoughts are, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now I'm gonna show you in a second an Excel sheet. We're gonna block out a few things, but we're gonna look at everything from home value, purchasing a property, what are the costs for holding a property like that, and then just simply comparing that with a property that you invest in. But you're not only gonna invest, you're also gonna go and rent somewhere that you actually enjoy. Now, story time. I'm 33 years old. I was born in Sydney and I've lived my entire life in Sydney. I've traveled a lot, so I've seen different markets, I've seen different experiences, and yes, it's been very interesting. However, one thing that I've noted, especially when I speak to a lot of you guys that contact us, I find that there's this big hurdle that most people have to overcome here in Australia. And that's this trauma that we've all grown up with, which is renting is bad, it's for poor people because they can't afford to buy a house. And so with that mentality, you've seen a lot of people, especially young people, say, I just need to buy a house. That's the fastest way I'm gonna grow my wealth. I just need a house, and then it doesn't matter because after that, I can at least say I own my house, my parents are gonna be happy because they won't think I'm poor, then I can go ahead and live my life. Well, what does that life actually look like? It's probably doing a job that you don't like, traveling back and forth by an hour and a half, or if you are living closer to work and living closer to the city, you're living in a cardboard box. So you need to know that there are other options out there. I'm sorry that the schooling system has failed us all, but lucky for you, you've come across this channel with a nerd who wears a black t-shirt and loves numbers and actually goes out and practices what they preach. I invest in real estate and I've been doing for the last 12 years, and my latest purchase was yesterday. I settled yesterday, which was really nice. So let's jump into some numbers. Now in this example, I want to show you home value of $1 million, and it's going to be growing at 4%. I'll also want to show you the annual cost, so to hold that property, and I'm going to show you a weekly cost, interest only, as well as interest plus principal, and then what the equity gain could look like should you purchase a property that goes up by 4%. Now, on average in Australia, it's closer to about 8% in terms of the growth that we get. The reason I've gone 4% is because most likely, most people in Sydney at least, for $1 million, you're living at least an hour away from the city. And what you usually see in areas like this, you've got smaller land, you've got higher levels of building to land ratios, and thereby you actually have a lot less green space. And that means that longer term, you don't really have the community and what everyone's been used to in Sydney, especially in the suburbs, where the average land size was close to 600 square meters, but now everyone's having to settle for about 300 to 350 square meters. So I've sandbagged it and said 4%. Now, the other thing to also consider is that some people might go, well, $1 million in Sydney is probably not buying me a house. It might buy me an apartment. And that apartment may not be close to the city, but it's close enough. And I'm buying a property that is most likely going to be in a high density apartment block, and that's going to skew the numbers as well because a lot of these areas actually don't grow at all. So I've gone in, sandbagged it. Again, I can't cover off every example in every city possible. Of course, your numbers will be skewed if you buy in, say, Brisbane or in Melbourne. But again, that $1 million price point will change as well. So let's go through these numbers. All right, so we've got here in the first column, home values after 5 years, and it's growing at 4% compounding annually. I've got here the annual cost. So what I've done here is I've assumed a 5.5% interest rate, and I've also included $6,000 worth of council rates, water rates, and insurances. That's something you're gonna have to pay if you own your own home. Now, I've also based this on a $1 million loan. So of course, if you're buying a $1 million property, you're not taking on $1 million worth of loans, but it's a lot easier because some people take an 80% LVR, some people take up a 90% LVR, and now you've got the home guarantee schemes, which will go up to 95% LVRs. So for the purpose of keeping this example really simple, I've gone in and said, you're assuming 100% LVR, but just know that's not how it works. Now I've got here the interest only cost, and you'll also note that the annual cost has stayed the same. Whereas we know that council rates, water rates, insurances will go up over time, but I haven't accounted for that here. I've just tried to keep it really simple. So interest only would be $1,173 a week, and the weekly cost goes up by about $300 to $1,426, because you're paying the principal as well. Now, if you look at the equity gain, of course, it's a compounding number, so it'll increase more than $40,000 per year. And what you see is after 5 years, you've now got $216,000 worth of equity in your property. So a lot of people, what they'll do is they'll look at that and say, oh, well, actually I bought at the right time. I bought a good property. It's gone up in value. What you need to consider as well is that, yes, we're growing at 4%, but what's the hurdle rate? What's the inflation rate? And if you're not outperforming that, it doesn't really make sense. Yes, you do have leverage, which means that you're actually outperforming the hurdle rate. A lot of people ideally want to just be in a position where they can have a house paid off, and then at that point, it actually doesn't make sense because you will be underperforming the entire market. So now what I want to do is I want to look at the rent vesting opportunity that we have right now. Now, the reason I have these numbers is not because I just picked them out of the blue. It's actually numbers that we've been doing at the buyer's agency at Search Property for the last couple of years. Now, the numbers are actually skewed and I've actually sandbagged it because my personal portfolio, and this is well before I knew much about actually investing properly, using metrics and data, I started 12 years ago, so there wasn't as much data as there is available now. So back then, honestly, there was probably a little bit more luck than actual knowledge, but I've built that over time. So my portfolio personally grows at about 11 to 11.5% every single year across the entire portfolio, which is fantastic because it outperforms the market every single year. Now, knowing how much more data I have and having a full-blown team at Search Property, my numbers more recently have actually outperformed anything else, and I've been purchasing a lot better anyway with the help of buyer's agents at Search Property. So now what I want to do is I want to say, okay, I'm doing 11%, but what are Search Property clients doing? And they're on average doing about 13%. So what I did was I said, look, let's make this fair and do it at 11% and see what the numbers look like. All right, so we're going to now reveal what this looks like. And we're going in and purchasing 2 500K properties. Is this still possible? Yes, it is. The time is running out though for those types of properties. I think on average, we're starting to see that actual value increase by quite a bit, at least for us and what we're purchasing. So I would say that number's closer to about 550 to 600, but we can still pick up properties at 500K. So again, keeping this example super simple, you could use the principles behind it to actually go and execute. So instead of one $1 million house that I live in, I'm now purchasing 2 investment properties for 500K each. The other thing that you'll note as well in this example as we go through it is I've also allocated $900 a week for rent as well, but we'll go through that in a second. So here I've got is $1 million worth of assets. Again, you're borrowing at 100% LVR, but you're not actually able to do that. And it's gonna grow at 11%. So that's that value here. And what we have here is the investment net cash flow. So in this example, I've gone in and said, okay, I've got the expenses, which is my mortgage rates, council rates, water rates, insurances, and then all of my mortgage repayments plus property management fees minus my rent, I'm gonna be out of pocket about $11,000. Now this is based on interest only, and if you want a detailed video around why we pick interest only instead of interest plus principal, comment down below and I'll make that video for you guys. So what we have here is this number actually reduces and then actually turns positive after about year 4. And the reason for that is because we're accounting for a 5% increase in rents. Now, in some areas, and my own portfolio have grown a lot more than 5%, but we've used that as an average, and that's gonna increase our cash flow at the end of the year. So it means by basically year 4, you should be neutral to positive cash flow. And now it's not a lot, so you're not gonna be able to retire off this money, but that's how it works. And you can see that reflected in the weekly cost. Now here we have rent and weekly cost. So what I have here is the actual weekly cost of holding the property, but also $900 in rent. And what I've done is I've increased that 900 to 1,000 to 1,100 to 1,200 and to 1,300. So again, I'm increasing that and I'm increasing that at about 10% on average as well. The numbers actually get crazy when you look at the equity gain. So what I've got here is 110,000 growth in year 1. And you can see straight away, I've got more equity in year 1. And by the end of year 5, I'm at $685,000 and I've got to live in a place that I've actually wanted to live in an area that I desire to. What you're doing now is borderless investing, which means if you're living in Sydney, you're not buying a 500K property that's gonna grow at 11% a year. What you need to do is look outside of Sydney, and that's the sort of stuff that we specialize at Search Property. So I'll leave a link in the description box below so you can check out details there. And if you need a mortgage broker to refinance things, looking at scaling opportunities, then I'll also leave a link in the description box to a mortgage broker as well. Now, here comes the big number that you're all waiting for. What we can see is after year 5, yes, we've got the equity gain of almost $500,000 more just by rent vesting, but you've also got a $600 cash difference in terms of cash flow every single week, What that means is, in example one, I'm still having to pay my mortgage. That means I'm stuck in that house, I can't make any moves. Now, the only way I can make a move is if I sell the house, I'm gonna have all the selling costs, and then I have to go and find a place, and again, you have purchasing costs like stamp duty. In option two, you look at your cash flow, and even though the place you're renting increases, you're actually gonna be net positive. And that's because you're controlling a lot more in terms of asset value, and you could also always move. So if you feel like you need to slow down in terms of how much you're spending, reduce that lifestyle, you can always move somewhere else. And that's the flexibility you get. And so despite that, you're actually gonna be ahead by $600 every single week. Now, what I wanted to show you is also this line, and this is very important. A lot of people often mistake this, they don't understand how it works, and it's very key, especially if you're wanting to buy your own place. And I get it, why you wanna buy your own place in Australia, I understand. You don't wanna be answerable to anyone, but the reality is the numbers do not lie. And this here is the kicker. If you structure this well, you can actually borrow so much more in the second scenario. So while many mortgage brokers that actually don't know what they're doing will go and tell you that, hey, you should buy your own place because your borrowing capacity is going to be wrecked once you're renting, they're actually incorrect because they don't know how to structure this properly. If you structure it right, the team at Refine Loans know exactly how to do this. It's going to allow you to borrow so much more. You'd also be able to take out some of that equity to go and buy more properties. So by the time you get to year 5, you might not be controlling $1.2 million or $1.6 million worth of assets. It might be that you've added 2 more properties to that equation, and now your equity gain is actually double, if not triple, during the next 5-year period. I've made a detailed video about how you can structure things properly with the help of Refine Loans. Definitely check out this video. It is one of the most popular videos on my channel now, and for good reason. Again, I hope you guys have enjoyed this video. I haven't covered off every example because it's simply impossible to. So I hope you guys have learned a thing or two. And if you have any questions, leave them down in the comments down below. If you have enjoyed this, smash that like button and I'll catch you guys on the next one. Thanks guys.